In the last lecture, in the last video, we have learned about the classification or kinds of accounting principles. Accounting principles are broadly divided into two: basic assumptions and basic principles. Basic assumptions are further divided into four: business entity concept, money measurement concept, going concern concept, and accounting period concepts. Now today we will take up the second types of accounting principles. These basic accounting principles are divided into 8 parts: historic cost, dual aspect, conservation, revenue recognition, materiality, full disclosure, verifiable objectivity, and matching. First accounting principle is the principle of historic cost or the cost concept. Principle of historic cost or cost concept. According to this concept, as per this concept, all the assets that are recorded in the business books of accounts are recorded in the books of accounts at their cost of acquisition. That means at their purchase price, the price at which they were purchased. This cost of acquisition includes the cost of purchasing, the asset, the transportation cost, and installation, purchasing expense, and all the expenses which are necessary to bring that asset into use. So this concept implies that all the assets of the firm or the business are recorded in the books of accounts at their purchase price. These assets should not be recorded at market price. It should not be recorded at the market price, but they should be recorded at the cost of acquisition, purchase price. The market price keeps on fluctuating day to day, so the assets should not be recorded at the market price. However, the cost principle, the cost concept of cost, the principle of historic cost, does not mean that all the assets will be continuously shown at the cost of acquisition for a long period of time. It is not that they are always, the firm will keep on recording the assets at their cost of acquisition year and year again. The cost of assets will automatically reduce from year to year by charging depreciation on the assets, and the assets are shown in the balance sheet at cost less depreciation. The second concept of accounting principle is the dual aspect concept. The first one was the principle of historic cost. Now second is the dual aspect concept. This concept implies that every transaction in accounts has at least two effects. Every transaction has two aspects, and both the aspects should be recorded in the books. In accounts, double entry system of accounting is followed, and in double entry, both the aspects are to be followed, are to be recorded in the books. According to this concept, every financial transaction has dual effect. Two effects. Number one, receiving of a benefit, and B, giving of a benefit. Every financial transaction has two effects. One is receiving of benefit, and B, giving of benefit. Whenever a transaction takes place, one party receives the benefits and the same party has to give a benefit to other. So both these aspects are to be recorded in the books of accounts. The receiving aspect here is termed as debit, and the giving aspect is termed as credit. So in accounts, for every debit there is a corresponding and equal credit. For every debit there is a credit of an equal amount, unequal quantity. Thus, this concept is the basis of the entire system of double entry system. In accounts, double entry system of accounting is followed, and in double entry system, both the aspects, the debit and the credits, are recorded. So this concept, the dual aspect concept, becomes the basis of the double entry system. It is the foundation of the whole bookkeeping and accountancy. As we know that every transaction has two aspects, and both the transactions have to be recorded in the books. So how to check this dual effect? To check the dual effect, we have a basic accounting equation. In every transaction, this accounting equation should be fulfilled. If this accounting equation is fulfilled, that means we are following the rules of double entry system. The basic accounting equation is assets is equal to capital plus liabilities, or asset is equal to total equities or total liabilities, or assets minus liabilities is equal to capital, or external liabilities plus owner's capital is equal to assets.